यूट्यूब लाइव पे सेट हो रहा है, जस्ट जस्ट 1 मिनट। यस। हेतल बेन, खाली देख लीजिएगा ना उधर बराबर चालू हो गया कि नहीं यूट्यूब पे।
Yeah, Harsh, I think in the meantime you can start. It will take some lagging
Oh,
there, so you can start.
yeah, sure. So, good evening, everyone. I welcome you to this online study circle. For some reason, we are not able to do the CP study circle as we generally do. Anyway, online would be much more preferable, at least for this topic. I very clearly remember it has been nearly 14 years now when we saw the infamous Vodafone Global case in 2012, which was one kind of a landmark judgment at that point of time by Supreme Court, favorable judgment in terms of the ruling. But in this 14 years, many changes have been happening, many amendments have been happening in income tax, and one of the major change was GAR, because of which we could see this judgment now going against in a favorable to revenue department. Probably this Supreme Court judgment has raised some of the questions the doctrine of substance over form, commercial establishment, lifting the corporate wheel, many such questions, and probably many entities, I would say, planning commission or some economic institutions, even foreign portfolio investors, many have gone into some kind of a limbo as far as this judgment is covered. I very well remember that for deliberating the infamous Vodafone judgment, also we had our learned speaker Vishal Gada. That time also 14 years back, and today also we are having him for deliberating this landmark ruling of Supreme Court. So thank you, Vishal Bhai, for taking your time out. We very well understand that this one kind of a ruling which actually requires many deliberations for some of the days, but it is I think only 1 week right now, and you are ready with the presentation. So we really thank you for the efforts which you and your team has taken. So without much ado, I would now request CA Zeel Vora to briefly introduce our today's speaker, CA Vishal Gadda. Thank you.
Thank you for giving me this opportunity to introduce our speaker for today, CA Vishal Gada. He has an experience of over 25 years in advising client on tax and regulatory domain. He is the CEO and founder of Otis Consultancy, which has been recently awarded the best tax farmer firm in Asia and International Tax Review. Prior to founding Otis Consultancy, he was a partner at KPMG and one of the co-founders of Dhruva Advisory. Vishal sir has consistently been featured in the list of top tax professionals in India in the survey conducted by the International Tax Review. Vishal sir has worked on numerous complex M&A transactions, corporate reorganizations, and regulatory issues. His area of expertise also includes devising succession structures, advising on domestic and international tax issues, and structures for inbound and outbound investment. He has co-authored a couple of books on professional subjects and is a regular speaker at various professional forums. With this brief introduction, I would now uh, I would now
Thank you, Zeel, for giving that brief introduction. I think most of the members in CVOC actually know Vishal Bhai very well. Is one of the learned, although young, but one of the learned faculties as far as income tax is concerned. As a token of our love and gesture, we generally give memento to the speaker, but it is very kind of Vishal Bhai to have us say that the equivalent amount of the memento will be transferred to Chartered Accountant Benevolent Fund on his name. So thank you for that gesture, Vishal Bhai. So now the floor is yours. I would request now to take up your deliberation. Thank you.
Yeah, thanks a lot, Harsh, Hetal, Zeel, and other members of CVOC Association. Candidly, it's always great speaking, in this forum because you feel you are back in the family. Thanks a lot for inviting me. I can't see the faces of many people, but I'm pretty sure I'll be knowing many of them, if not all. How I thought, we can probably structure this presentation for the next 90 minutes It's a small crowd, I'm presuming, right? We just have some 35, 40 people. And I think we like to take a practitioner's perspective. And while there is a presentation, which I will put it up on the screen shortly, maybe I'll go through the facts. What was the facts? What was the history of the whole litigation? Because it all started with an application under Section 197, which was denied, and then it went to the AAR, it went to the High Court, it finally came to the Supreme Court. Uh, and at the end of, maybe the Supreme Court decision, I think we can all jointly try to deliberate as to what has changed. Are any new principles of treaty interpretation emerging? Was this decision more under the domestic tax law, applying the anti-abuse regulations? Let's say as a chartered accountant, we are issuing Form 16 CB. What is the liability on a chartered accountant after this decision? Many of us might, also be part of large firms which are, let's say, advising clients on inbound structures, outbound structures. Does this decision now impact many of these structures? So, I'm not sure, Harsh, whether people can, interrupt in between, but I don't mind if there are any questions,
Yeah,
happy.
so
Yeah.
just to announce, if anyone has any question, then they can write it in the chat form.
Perfect, perfect, perfect. So let me put up my screen, and are you able to, just a minute, I'll blow it up, see the uh,
Yes.
presentation? Hmm?
Yeah.
Okay, okay, excellent. Just a minute. Yeah. So I think very broadly, I thought we'll just touch upon the facts. Uh, and just a minute, I'm just trying to put this screen on the side. Okay. Harsh, is the screen completely visible or the face is coming in between? How is it?
No, we can just see the screen. That's it.
Okay, perfect, perfect, great. Because for me, I'm able to see all of you, but on the side. So maybe I'll move it for my convenience per se. See, what was the transaction? If you would have heard a couple of years back, right? Flipkart, which was founded by the two Bansal founders, got acquired by Walmart, which was the US group. And the structure was that there was a Singapore company known as Flipkart Private Limited, which then owned multiple Indian companies. The diagram is just showing one company, but there were multiple Indian companies under the Flipkart Singapore company. And at some stage, we had investors, coming into Flipkart Private Limited Singapore. And one of the key investor was the Tiger Global Fund. It was really this fund which gave the initial seed money and subsequent funding to Flipkart, which was instrumental in its future success. What the facts tell us is that there are apparently three Mauritius companies which are holding the shareholding in Flipkart Singapore. Those three Mauritius companies are held by a series of Cayman structures and Mauritius structures. Uh, and ultimately, if you look at the main Tiger Global Fund, the investment manager of these companies, that investment manager is a LLC, a limited liability company, which is based in USA. And obviously, the main founder of Tiger Global Fund, Mr. Charles Coleman, he's also based in US. He's a US resident. The facts tell us that effectively these three companies have two Mauritius directors, one non-Mauritius director, and also the charter of these three companies basically say that any banking transactions above 0.25 million, which is a quarter million, is something which will be approved by Charles Coleman, which is based in USA. The facts also seems to suggest that Charles Coleman is also one of the sole director, not in the three Tiger Global Company, which is the subject matter of this whole dispute, but in the series of Cayman and Mauritius companies. And the transaction was that these three companies sold their shares in Flipkart Singapore in financial year 2018-2019 to a Luxembourg entity, and we are presuming the Luxembourg entity ultimately would be part of the Walmart group. The whole issue for consideration is that when the Mauritius company sold the shares of Flipkart Singapore, and Flipkart Singapore derived all its value from its entities in India, whether such a sale transaction of a Mauritius company selling shares of a Singapore company to a foreign buyer, which is Luxembourg in our case, but it's irrelevant, is that subject to capital gains tax and subsequent withholding, or is it subject to exemption under the treaty? And the relevant treaty under question is again the infamous India-Mauritius Treaty. And with this factual background, let's jump into the case study. So couple of facts I've already mentioned, so we will not repeat. What happened? Tiger Global basically approached the Indian tax office. They filed an application under 197 and they requested the tax office that we are Mauritius companies. Here is the TRC. We are eligible for the benefits of the India-Mauritius tax treaty. And please grant us a nil withholding tax certificate. The tax office, as expected, said, sorry, we do not think you should be eligible for treaty benefits. You are not necessarily independent in your decision making and control. And therefore, they denied any nil withhold, certificate, and they issued a withholding tax order with some specific tax rates, 6 point something. We are not right now relevant about it. What happened was Tiger Global also filed a ruling before the authority for advance ruling, where they asked a specific question to the AAR, which was whether capital gains on sale of shares of Flipkart Singapore, is it at all taxable under the India-Mauritius Treaty, or it is exempt under the India-Mauritius Treaty. The AAR refused to admit that application on the ground that basically the transaction was prima facie designed for tax avoidance. This is one of the ground necessary. The taxpayer has to demonstrate that whatever question is being put up before the AAR, the relevant arrangement, the relevant transaction cannot be prima facie designed for tax avoidance. And the AAR said that, we don't want to answer that question. We are rejecting your application for so and so reason. And we'll see what were the reasons given by the AAR. After that rejection, the AAR filed a writ petition before the High Court. Technically, if you look at the Income Tax Act, there is no specific section under which you can file an appeal to the higher authority once the AAR rejects that order, and therefore the normal practice is to file a writ either before the High Court or before the Supreme Court. Sometimes in the past, the writs were also being filed before the Supreme Court, but then the Supreme Court said, don't come to me, first you go to the High Court. So the current practice since last many years is that if the order of the AAR is negative or they have rejected your application, we will typically file a writ before the Bombay High Court. So they filed, a writ before the High Court. Here, of course, the writ was filed, if I remember, before the Delhi High Court. And the High Court gave a favorable order in favor of the taxpayer. They basically quashed the AAR order and basis certain reasonings, which again we will see. Against that, the tax office, obviously filed an appeal before the Supreme Court. So if you really look at the whole order of litigation, it is not that there was a negative assessment order, right? There was a 197 application which got rejected. Parallelly, there was a AAR filed by the taxpayer. The AAR was negative. They went to the High Court. High Court was positive in favor of the taxpayer, and the tax department filed against the Supreme Court. So this was the question before the Supreme Court, that does it believe that the AAR was right or wrong in holding that the transaction was prima facie designed for avoidance of taxation. I'm just reiterating a couple of facts. As I mentioned to you, these taxpayers were incorporated in Mauritius. They were basically holding category 1 global business license. So the companies in Mauritius, whenever you incorporate, typically they are either a GBL1 or GBL2. A GBL2 is an offshore company which does not get a tax residency. in Mauritius. A GBL1 company typically is an onshore company which gets a tax residency. So these companies were obviously GBL1 license holder. They were regulated by the Financial Services Commission in Mauritius. And typically these companies were acting as a pooling vehicle, where the fact says that more than 500 investors had come together to put in money, and that money was then deployed, into Flipkart Singapore per se. These entities held a valid TRC, and which obviously was one of the most vociferous argument of the taxpayer that you should, grant me treaty benefit. Uh, Two Mauritius directors, one US resident director. The entities had offices. They had two employees. It's not very clear whether those two employees were common or not from the decision. The principal banking account were in Mauritius. Accounting was being maintained in Mauritius. Accounts were being finalized in Mauritius. Audits were happening in Mauritius. And the fact says that while the US entity, which is TGM LLC, was the investment manager, they did not have the authority to conclude contracts. Finally, whatever investments were to be made, or whatever investments were to be sold, it was finally the decision of the board of directors of the Mauritius companies to take a call. That's what the facts tell us. Uh, why did the AAR, Authority for Advance Ruling, hold that the overall transaction was prima facie designed for tax avoidance? So these were some of the reasonings and observations by the AAR. They said that, the head and brain does not sit in Mauritius, it sits outside Mauritius. The real control over the over the Mauritius entities was exercised by Mr. Charles Coleman, and who was ultimately the key founder of the Tiger Global Group. Uh, there were also certain documents filed before the regulatory authority showing Mr. Charles Coleman as the ultimate beneficial owner. Uh, the control and management, therefore, was situated outside Mauritius, and it was actually situated in USA. This was the observation of the AAR. It also observed that, the real intention for obtaining TRC and for having these companies in Mauritius was to avail the benefit of the India-Mauritius Treaty. In fact, in the decision, and I was reading it again for the second time today, somewhere they have observed that these Mauritius entities only held share in Flipkart Singapore. So these three Mauritius companies had only one asset, which was shares in Flipkart Singapore. It wasn't that they were holding multiple investments around the globe. No, only one asset, shares in Flipkart Singapore. So obviously, the AR observed that the real intent only and only is to take tax benefits under the DTAA. It interestingly also said that the contention of the taxpayer that there is a treaty benefit under Article 13.4, and maybe we'll go through the wordings of Article 13.3A, 13.3B, 13.4 is something which are not available because the Mauritius company was not holding shares directly in the Indian company. Under the India-Mauritius Treaty, the capital gains tax exemption is available only if the Mauritius company holds shares directly. Here, the Mauritius company was holding shares in a Singapore company, which in turn was holding into the Indian company. And therefore, the AAR, which in my view was a wrong interpretation of the treaty, said that, sorry, you cannot claim benefit under Article 13. And they therefore held that, the overall transaction is designed for avoidance of tax. And therefore, we are rejecting this application. We are not even allowing it to be admitted per se. This is overall why the AAR rejected, the application. Now, when the taxpayers appealed before the High Court, uh, sorry, the High Court ultimately said that, no, we disagree with the AAR. And these were some of the rational and observations which the High Court order seems to document. Very interestingly, they said that, the AAR's findings appear to be conclusive rather than a prima facie examination. And in a way, they just put a question mark that why was the AAR going into so much of detail at that stage? Which was an interesting observation by the High Court, which effectively, in a very soft and implicit manner, it is chiding the AAR that, why are you getting into so much of detail at this stage? Which I don't know why it had to make, those observations. It said that, the US entity is only an investment manager, and it had no equity participation in the Mauritius entities. And it also observed that effectively this is a company where many hundreds of investors from 30 jurisdictions, they have put in almost $1.76 billion. These pools have been collected into the Mauritius entity. So you cannot dismiss these entities as lacking economic substance, because the purpose of creating these three Mauritius companies was to act as pooling vehicles where you could invite hundreds of investors. Also, they made an observation that it is not that this investment in Flipkart Singapore was held for a very short time. There was a long-term investment for more than a decade. And basis this, it said that we believe that there is enough economic substance into the three Mauritius entities. It also said that, see, the subsidiary is not a mere puppet. Merely because there are directors based in USA, merely because some power is given to, let's say, Charles Coleman to authorize transactions beyond $250,000, does not itself mean that the subsidiary does not exist. It does not allow you to lift the corporate well. And they went through the board resolutions, they went through the board minutes, and they made a specific finding that basis the board minutes, it seems that the board was taking the decisions, and therefore they said that we are satisfied with the stand-alone control and management of these three Mauritius companies. They also said that you cannot basically say that the investment manager is the beneficial owner, because there was no evidence to demonstrate that whatever capital gains or whatever income comes in the Mauritius company, the Mauritius entities have to legally transfer it back to TGM LLC, which was their investment manager. And therefore, they said that, the beneficial owner of the income was the three Mauritius entities per se. They also basically made a specific comment that the TRCs which were obtained by these three Mauritius companies, it has to be respected by the tax office. And only if the tax office is able to find some kind of a sham transaction, complete absence of economic substance, are they allowed to ignore the TRC and then get into the detail and in a way pierce the corporate veil. So, the High Court was very clear that basis the Azadi Bachao Andolan, etc., the tax office is not allowed to do that. It also observed that there is already a limitation of benefit clause and under the treaty, and the limitation of benefit clause has certain tests. Most of these tests are expenditure related tests, that if the Mauritius entities carry out certain minimum amount of expenditure, they would be deemed to have satisfied the limitation of benefit clause. And therefore, they observed that there is already an anti-abuse check inside the treaty. So why is the AAR basically saying that these entities are not eligible for the India-Mauritius treaty? And surprisingly, they said that surprisingly, the High Court said that while Article 13(3)(a) of the India-Mauritius tax treaty talk about investment in shares of an Indian company, and in the current case, the Mauritius company were not holding shares in the Indian company. But you have to look through and you have to look at the substance, that effectively all the value of the Singapore company was being derived from the investment in the Indian companies. And therefore, Article 13(3)(a) should be the right article under which the tax benefits, the tax exemption on capital gains should be given to the taxpayers. So they said that no, this is a transaction which is completely exempt under Article 13(3)(a). And maybe before I move to the Supreme Court decision, let me share the text of Article 13(3)(a), 13(3)(b), and Article 13(4). And maybe we'll just spend 5 minutes on that so that we just understand, how different courts have held, under different sub-articles, which itself is fascinating. Just give me a minute. I'm just opening, the India-Mauritius Treaty. Okay, I'm just sharing my screen again. Are you able to see my screen?
Yes, yes.
Thanks a lot. Thanks a lot. So I just go to Article 13, and first let's just focus on 3A, under which the High Court said that the capital gains exemption should be available. So it said that gains from alienation of shares acquired on or after 1st April 2017 in a company which is a resident of the contracting state may be taxed in that state. Then it said, however, the tax rate on the gains referred to in paragraph 3A of this article and arising during the period on or after 1st April, but up to 31st 29, shall be taxed at 50% of the rate. So what the argument of the tax office was that under 3A, you have to have investment directly into the Indian company. The High Court said that no, it is not relevant. Under 3A, even if the investment is into the Singapore company, even in that case, Article 3A says that gains from alienation of shares shall be taxable only in the contracting state of which the seller is a resident. So effectively, the High Court went by the literal reading, saying that 3A, which says gains from alienation of a shares, the shares can be of an Indian company, the shares can also be of a Singapore company, does not matter. As long as the seller is a resident of Mauritius, it fits under Article 3A. And why we will come back to this article again and again, because when Supreme Court holds, we will again read it again as to what was their interpretation around it. So I think with this, the taxpayer won the battle at the High Court level, and then the tax office appealed, before the Supreme Court, and this is where we now have this fascinating judgment, and we'll debate around it. Now, before I get into the Supreme Court decision, I just thought it's good to just spend a couple of minutes on the whole legislative framework around the India-Mauritius Treaty. So I've just created a small timeline. So if you look at the treaty, it was executed somewhere in 1982. Somewhere in 94, there was a circular by the Indian government which confirmed that only Mauritius have the right to tax the capital gains on sale of shares. This was reconfirmed in 2000, via circular number 789, which said that as long as the taxpayers, the Mauritius companies are able to bring a TRC would be regarded as a conclusive proof. Nothing more would be required. And it was against that circular that you had a NGO, which was named as Azadi Bachao Andolan, who filed a case, but ultimately the Supreme Court, held in favor of the Mauritius entities. Again, in 2003, there was a circular issue that if a taxpayer is a resident of both countries, then you will apply the test of POEM, place of effective management, to decide as to where the residency is. Of course, then 2004, you have the Azadi Bachao Andolan decision. Many of us had just cleared CA a couple of years back, so this was our first tryst with the Danbag decision. In 2012, you had the Vodafone decision, which of course accepted the TRC, but it made an observation that you can look beyond TRC only if there is a absence, if there is a presence of a sham or a fraud transaction, etc. So there was some observations in the Vodafone decisions which kept certain windows open, that yes, the tax office can go beyond TRC, but if they have been able to demonstrate credible evidence that there are certain sham arrangements, there are certain fraud transactions. Then what happened after the Vodafone decision? Obviously, the government changed the legislative framework. For example, it brought about indirect transfer, which of course was leviable from a retroactive date, which itself, was criticized a lot globally. That after losing before the Supreme Court, the government still brought in a legislation trying to tax the Vodafone Hutchison transaction. And here people have to remember that Vodafone was the buyer, not the seller. The seller was Hutchison, who made a lot of money. But this was the irony that the buyer, as Vodafone, got embroiled in this lengthy litigation. So 2012, 2013, as I mentioned, indirect transfer provisions were brought in, GAR provisions were brought in, which of course were made effective only from 1st April 2017. There was a very important Shom committee report which said that we have to create relevant safeguards under GAR because that's too much of power to the tax office, etc., etc. 2016, the tax treaty got renegotiated. Effectively in 2016, what happened? The capital gains exemption was done away with, but there was a grandfathering. So, the Article 13(3)(a), what we were reading, it said that if the shares in an Indian company have been acquired prior to 1st April 17, then the capital gains exemption will be available. After that, for a period of 2 years, if there are any investments made till 31st March 2019, then capital gains tax would be leviable, but at a 50% discount. And thereafter, any investments after 1st April 2019, obviously they would be taxed as per the normal tax rates applicable. So that was a very important amendment in the treaty. And in 2017, you had the GAR provisions becoming effective. Thankfully, you do not see many GAR applications, in the real world. The worry was that would the tax office start applying, the rigors of the GAR to every second transaction. But thank God you see that only in far and few cases today. Then somewhere in 2024, the protocol was proposed to be amended. In fact, it got amended. What it said was that we will bring the PPT test into the tax treaty, but this is not yet made effective, right? So while the protocol has been agreed between India and Mauritius, they are yet to make it effective, which I think will happen this year or whatever, very likely it should happen this year, which effectively said that forget GAR for a moment. Even under the tax treaty, if any company has to take a benefit of the India-Mauritius treaty, it will have to satisfy the PPT test, which is nothing but part of the MLI multilateral instrument project of OECD. And the PPT test, which is principal purpose test, simply says that if one of the main benefit or one of the main intention of entering via Mauritius was to avail tax benefits under the treaty, then these benefits will be denied. In fact, if you ask me, the PPT test under a treaty is much wider than GAR. GAR says the main benefit has to be tax benefit, whereas the treaty says one of the main benefit has to be tax benefit. To that extent, I think I would say you will see much more litigation happening under the PPT test, compared to a GAR provision, etc. per se. Also, mind you, that if a tax office wants to apply GAR, it will have to go and get approval of the internal GAR panel, which is not very easy, as some tax officers have mentioned. They have to work very hard, to get such an approval. But if they have to deny you the tax treaty benefits basis the PPT test, right, principal purpose test, it is much, much easier per se. Of course, the whole concept of PPT test is not relevant to the India-Mauritius tax treaty today. Why? Because this has not yet been made effective. And therefore, you do not see mention of any PPT test under the current Supreme Court decision per se. So that's broadly, as I mentioned, the overall legal framework. So obviously this India-Mauritius treaty has been attacked multiple times, has been defended multiple times. Many times, or most of the times, the government has come to the rescue. Couple of times, like the Azadi Bachao Andolan case and the Vodafone, the Supreme Court has held in favor. Sometimes the government has played a villain's role on a lighter note. For example, when it introduced the indirect transfer provisions retroactively, and it was government who said that let's drop all this zero tax capital gain. So they renegotiated the treaty in 2024. So it's a very interesting journey. This treaty has gone through its own ups and downs per se. Yeah. So I think with that, let's now jump into the key thing, which is, I just thought it's important to spend some time on this, because now it will be much easier to understand the whole Supreme Court decision. So number one, uh, what were the arguments made by the tax office, before the Supreme Court? And I can tell you the arguments which were made by the tax office before the Supreme Court were much more wider in scope, and the quality of arguments which they made before the Supreme Court was top class compared to, let's say, what they were arguing before the AAR or before the High Court. So obviously, I think the tax office had prepared, much better. So first argument they were making was that, this is just a prima facie view AAR is observing, because under the AAR framework, if prima facie the AAR believes that the transaction is for tax avoidance, then it can refuse, to admit any application per se. So of course, their first point was that the right of deciding on a prima facie basis should be given to the AAR. Second, it said that the TRC is not conclusive. It said that there has to be an application of substance over form rule. The tax office should be allowed to look into the control, management, economic substance, and the tax office cannot be forced to look at just TRC. This was the second argument. The third argument was, they said that they believe, basis the specific facts, that these Mauritius companies were not genuine residents of Mauritius because the place of management was not in Mauritius. And of course, there they repeated the same facts. One of the key fact was that a transaction above $250,000 has to be approved by somebody sitting in USA. They also observed that, if you look at the overall chain of companies, etc., this is all and all only and only to, take benefit of the treaty per se. Now, for the first time, they are making a very important argument that in any case, forget the treaty, in any case, the Indian anti-abuse rules, which is general anti-avoidance regulations, is applicable, and a GAR provision overrides the tax treaty. And therefore, even under GAR, this whole structure should be regarded as an impermissible arrangement. And therefore, applying the powers of the GAR, we should deny the tax treaty benefits. So this was a very important argument, and possibly made for the first time, in the Supreme Court. They also said that while there is a concept of a grandfathering under GAR, which is effectively, Rule 10U, Sub-Rule 1, Clause D, they said that the grandfathering is applicable only and only to investments and not to an abusive arrangement. And they quoted some reports of the Shom Committee and said that in this case, this is not an investment, this is an arrangement And of course, I'll come later what did Supreme Court said. And therefore, they said that there is absolutely no grandfathering allowed. So while these investments were almost 10 years old, done much prior to 1st April 2017, they said, sorry, we should not allow the Mauritius tax payers to take the shelter of grandfathering under GAR. They also said that, see, the whole spirit, and see, when you are arguing before the Supreme Court, you will make all arguments, right? Whether they are tenable, not tenable. So they said, you know what? You cannot have a scenario where you are not paying tax in India and you are not paying tax in Mauritius. And in this case, they are not paying tax in Mauritius. How can we stop them from, not paying tax in India? So this was, the same double non-taxation argument which was put up in Azadi Bachao Andolan. Interestingly, they also said that in addition to GAR, the general anti-abuse rules, which they called as JAR, JAAR, Judicial Anti-Avoidance Regulations, effectively the McDowell principle, which said that colorable devices are not allowed. So they said, the McDowell rule is live and alive. It is kicking and it is applicable. And they said, forget GAR. In addition to GAR, I can also apply JAR. I love these, synonyms which are there, Then they also said that the High Court has wrongly interpreted Article 13. This transaction is not covered in 13.3a, it is covered in 13.4. And why they wanted to argue? Because even under 13.4, the taxability is in Mauritius, But if they would have agreed, if the tax office would have agreed that the taxability is under 13a, then the tax office will have to deal with the argument of the taxpayer that 13A already has a anti-abuse rule, a limitation of benefit rule. And therefore, moment it is satisfied, you might have to give the benefit. So they said that no, it is not taxable under 13.3A. It is taxable under 13.4. And under 4, there is no concept of an LOB because the LOB clause of Mauritius applies only to 13A. And because there is no concept of an LOB under 13.4, you have to rely on the LOB clause, which is the anti-abuse clause under the Indian domestic tax law. So that was an interesting argument they made. They also said that the prime objective was treaty shopping. So treaty shopping cannot be allowed. And they also pointed out that all these arguments of Azadi Bachao Andolan, the 789 circular, etc., they happened in an era where GAR was not there. And therefore, one has to look under the revised legislative framework. And therefore, you cannot take the circular in its entirety. That circular has to be subject to the legislative framework appearing at that point of time. And at that point of time, GAR was not available. So today, the tax officers cannot be forced to follow the circular because there is a judicial framework of a legislative framework of a general anti-avoidance regulations per se. I think a very, very interesting argument. As I mentioned, they were very, very well prepared, So these were the contentions of, the taxpayer. Compared to that, I thought, and I read the decision, and I don't know whether the decision documents all the arguments of the taxpayers. But I just thought, the arguments of the taxpayers was the same, nothing different. And what it basically said is TRC, TRC, TRC. Please look at TRC. I am a resident of, Mauritius. Basis the circular, TRC has to be regarded as the final evidence. They also said that sometime in Finance Bill 2012, there was a proposal to put a clause in Section 90 saying that TRC will not be conclusive of the treaty benefits of the residency. And then when the Finance Bill became Finance Act, the government dropped that clause and they came up with a press release reassuring the department that we will respect TRC. And the taxpayer argued that, look at it, there was an intent of the government to give sanctity to TRC, because if there was no intent, the government would have gone ahead and made that amendment under Section 90, which basically says that the TRC is not the final evidence. but they did not. And therefore, implicitly, it should mean that the government should have the intent of making TRC the final evidence. Good argument, very good argument, something which interestingly the High Court had accepted, in its decision. They also said that, forget everything. My structure is grandfathered. The Mauritius companies have made investments prior to 1st April 2017, and therefore you cannot apply GAR. This structure is grandfathered. And they said that if you go with the interpretation which the tax office is arguing, that only investments are grandfathered, but abusive arrangements are not grandfathered, then it will make clause D odious. Because only if it's an abusive arrangement that you need protection from GAR. If it is not an abusive arrangement, if it's a simpliciter investment, why do I need the grandfathering? Why do I need the protection? So they said grandfathering has to be available, and only investments after 1st April 17 should be tested under GAR. Of course, they also said that there is a commercial purpose. This whole transaction was acquired by Walmart as part of a global blah 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 business strategy. They also made an argument that treaty needs to be looked into in isolation. You cannot bring the domestic anti-abuse rules into a treaty interpretation. They also argued that Mauritius companies were well regulated in Mauritius. There is a authority, Financial Services Commission, which is regulating all this, etc., etc. So these were some of the arguments which were made, by the taxpayer and their councils, etc. And what did the Supreme Court held finally? And this is where, as I said, the bulk of our discussions are going to happen. The Supreme Court said that, number one, a mere existence of TRC does not establish residential status. It said that merely you show me a TRC, a tax residence certificate, does not mean that you are eligible for the tax treaty. And this, they connected it with the applicability of GAR. They basically said that, and if you really look at the decision, it's very interesting. If you look at the decision, the first words of the decision is, the power of an independent republic to levy and collect tax forms part of its inherent sovereign functions. The first line of the judgment starts with the fact that Supreme Court is saying that it is the sovereign function and the sovereign right of India to collect taxes. If you look at the end of the judgment, the main judgment has been drafted by Justice Mahadevan. The second judgment has been drafted by Justice Pardiwala, and Pardiwala has drafted the judgment completely. It's a 5-pager judgment, a small one, compared to Sri Mahadevan, who has drafted almost a 145-pager judgment. But the Pardiwala judgment is only on sovereign right of taxation, where he is actually advising the government that this is how you should negotiate treaties, etc., and this is how you should protect the sovereign right. But it seems that the judges were absolutely convinced with the argument of the tax office that the sovereign right to collect tax is that of the Indian government, and therefore the domestic tax law will always override the tax treaty. And that was in the context of the tax office's argument that GAR has to override a tax treaty. A tax treaty cannot be a standalone instrument per se. And it seems that the judges are completely convinced if you look at the language, the tone in which they have drafted it. So the judges have absolutely no doubt that GAR is applicable and it overrides tax treaties. And it said that once it is found that there is an impermissible arrangement, then the tax officers are right in applying GAR. Now, interestingly, if you really look at the whole judgment, the judgment is more on the principles. But if you look at, was the tax office very vocal about why it believes that this was an impermissible arrangement, control and management? Absolutely. Were these analyzed by the Supreme Court? And apparently only in one page, in para 50, where the Supreme Court is merely mentioning that the revenue has proved that the transactions in the instant case are impermissible tax avoidance arrangements, and the evidence prima facie establishes that they do not qualify as lawful. This is it. The Supreme Court does not discusses whether the control was in Mauritius, outside Mauritius. The Supreme Court does not say that I'm convinced that because Charles Coleman, I was going to say Charles Shobraj on a lighter note, Charles Coleman has the right to authorize transactions, and hence we are convinced that the place of management is outside Mauritius. Nothing of that sort. In the whole decisions, the Supreme Court is looking at legal concepts, looking at TRCs, looking at GAR, looking at JAR, grandfathering, interplay between domestic and TRC, sovereign right. And then in para 50, it is saying the revenue has proved that the transactions in the instant case are impermissible tax avoidance arrangements. And the evidence prima facie establishes that they do not qualify as lawful. So while of course it's a one-line judgment, the way to look at it is that they are convinced under the current facts that there is no enough economic substance in Mauritius, etc. But just one line in 150-pager judgment. So obviously TRC not conclusive as per Supreme Court. GAR is applicable. Very interestingly, while of course GAR overrides treaty, which even I believe clearly GAR overrides treaty, but very interestingly, they said no grandfathering is available. And this is where, if you ask me, I believe that if you go with what Supreme Court has said, it has effectively made the grandfathering provisions odious. If I have to verify whether every arrangement is abusive or not, then where is the question of me being protected? If I have made a sin and a law says, okay, I will not penalize you for that sin, that is a protection. That is a grandfathering. But if I have not made a sin, where is the question of me requiring any kind of a grandfathering, me requiring any kind of a protection? And that is the way they have in U1D with Rule 10U2. Right? It is going to be debated forever and ever unless the government comes and makes some amendment to make it more express as to why and for what it intends to give grandfathering. But today the Supreme Court decision is the law of the land. You have to accept it whether you agree with it or not. And basis this, I effectively believe that there is no grandfathering available. Every structure, every transaction, you have to check whether it is abusive or it is not abusive. So Supreme Court said, sorry, grandfathering available only to investments, but they are not available to an arrangement, an abusive arrangement. But whether an investment is an abusive arrangement will now have to be evaluated per se. So I don't foresee a scenario where somebody has got any tangible benefit because of the protection per se. Now, one very important thing, see, if you look at the GAR provisions, the GAR provisions have two levels of test. The first level of test is that, is it an impermissible arrangement to avoid tax, to gain tax benefit? And if you pass that, then there are four other tests, which is the second level test. Right? For example, was the transaction at arm's length? Did it abuse the spirit of tax laws, etc., etc. But here that has not been discussed per se. Only the first level of tax has been discussed, and which means that maybe the taxpayer may file a review petition saying that, wait a minute, you have tested the first level of test, please test the second level of test. Of course I don't know what, I don't expect that also to be successful for a variety of reasons per se. But interestingly, they have stopped at the first test. Of course, they had to conclude that prima facie we agree with AAR that this structure is for tax avoidance, and hence the AAR was right in rejecting the application per se. But yes, very importantly, they have not tested the second level of test, which is four tests, where if any one of the tests is satisfied, finally the GAR is attracted. Interestingly, there is a observation of double non-taxation. Now, this is where I believe it becomes dangerous. It basically says that a treaty benefit is available only if there is a double taxation. So it envisages that the transaction has to be taxed once. Now, how do you reconcile that? Because does it mean that every time you want to apply a treaty, give benefits of concessional tax rate or give benefits of an exemption, you will have to look whether or not it is taxable in the home country? And I think this is going to be interesting because the tax office are going to put that line saying that this is one of the observations of the Supreme Court, and this is going to become one of the principles of giving you a tax benefit under a treaty. You have to prove that there is a taxation in your home country only and only then you can seek exemption in India. And I'll give you a classic case. I'm a resident of Dubai. I'm investing in listed derivatives under the India-Dubai Treaty. A capital gains from listed derivatives cannot be taxed in the hands of a Dubai resident. But I'm not taxable in Dubai, right? Because the personal income of an individual is not subject to tax in Dubai unless it is regarded as a business activity. Now, can the tax office says, wait a minute, the treaty says so, but the Supreme Court says you have to be paying taxes in Dubai because you are not paying taxes on this capital gain on derivatives. I will not grant you the exemption under the India-Dubai Treaty. Is that what would be the case? And in my view, that would be slightly far-fetched to come up with a simple rule that you have to pay tax in the home country. I do not think that is what the Supreme Court intends by putting that one line. I think the manner in which one can reconcile that observation that treaty benefits are available only to avoid double non-taxation, only to avoid double taxation, is to say that in the instant case, the Supreme Court got influenced by the fact that one of the purpose of setting up the company in Mauritius was not to pay tax in India and Mauritius. And therefore, I believe those observations have to be read in a contextual manner and not in a literal manner where you will apply it to every treaty. And therefore, only in an abusive arrangement, I think the Supreme Court effectively is trying to say that where there are no taxation, neither here, neither there, right? The tax officer has a right to get into detail as to what was the intent of that structure. Was the intent not to pay taxes anywhere? If yes, then yes, this is something which is an impermissible arrangement. So I do think, but I do hope the government brings some kind of a press release, a circular, else this one line of the Supreme Court is going to haunt, many, many taxpayers per se. Somewhere, the Supreme Court said that the indirect transfers are not covered under 13(3)(a), they are covered under 13(4). Effectively, every argument of the tax office has been accepted by the tax office. Every argument. I've hardly seen where every argument of the tax office is accepted by a court. But the court says, that sorry, this was not a direct transfer. Mauritius transferred Singapore. Singapore had value in India. This was taxable under Section 9, under the indirect transfer provisions, effectively the Vodafone transfer provisions. And 13(4) did not had any LOB. 13(3)(a) had an LOB. But even if the Supreme Court would have held that it is taxable or covered under 13(3)(a), I think they would have still applied the treaty override clause under CAR. So I don't think it would have made much difference. But effectively, it says that only and only direct transfers are covered under 13(3)(a). All indirect transfers are covered under the residuary clause 13(4), where there are no anti-abuse rules applicable. Now, interestingly, that can also be used in a positive manner in a couple of other treaties, but we'll wait and watch per se. And they have made a specific finding that effective management governs corporate residency. I do not know whether that is a correct statement. To say that your residency depends on where are you controlled and management is going slightly beyond treaty, because the treaty definition in most cases simply say that you are resident in a country where you are liable to tax. It does not necessarily say that your control and management has to be there. That is something which is a feature of the domestic tax law. So I would say it's very, very accurate statement, but one has to read it in the context in which this matter was being litigated per se. Effectively, they have accepted that yes, in addition to GAR, a JAR exposure also is there. What they're effectively saying is that even if you come out of GAR, The tax office is right in applying the McDowell principles to say that is there any colorable device? Of course, in my view, a GAR is much, much wider compared to the observations of the Supreme Court in McDowell. But yes, what it simply says is that you cannot just analyze GAR and sit at peace, etc. You have to look at, is there a scope where a particular transaction structure would be regarded as a colorable device, etc. And of course, it has reiterated that we just cannot rely on circulars. You have to look at the legislative context available at that point of time. And all the circulars were pre-GAR. None of the circular is post-GAR. And therefore, it's incorrect to blindly rely on a circular, and which I think is the correct, way of interpreting a circular. Obviously, the circular reflects the position at that point of time. And if there is a change in law, which is introduction of GAR, then the tax officers have the right to explore whether an arrangement is covered under GAR or not. And again and again, they have reiterated that finally, it is the sovereign right of the Indian government to levy tax. So that's an interesting way they have started with the order and they have ended with that order per se, right? So it seems that they have been utterly mesmerized by the tax office's argument, which was done by the ESG, that India has the sovereign right to tax, and you cannot lose a chance to tax such transactions, etc. per se. So what does it mean? And clearly, first, uh, treaty shopping, in my view, is dead. You cannot just come into India via Mauritius, via Singapore, via Netherlands. Sorry, you cannot do a treaty shopping. Uh, One, because of this decision, which heavily relies on GAR. And second, in many of the treaties, while in Singapore treaty, the MLI PPT test is not there. In most of the treaties, the principal purpose test operated. How would you prove that the principal purpose or one of the principal purpose of coming via Netherlands, coming via Singapore, coming via some other tax haven was not to take the treaty benefits? Yeah, it's a huge ask, and obviously it will depend on the specific facts as to why have you incorporated that. So in my view, treaty shopping is dead. And therefore, your international structures will now be more flatter, will now be more simpler. Paper companies just cannot, help you per se. You will have to demonstrate economic substance per se. Clearly, TRC is not conclusive. TRC may be conclusive of access to treaty, but you have a GAR which overrides the treaty, which effectively means that a conjoint reading of the treaty and the anti-abuse rules in India, which is GAR. Sorry, TRC is not conclusive. Your control and management is very, very important. I visited many years back Port Louis, the capital of Mauritius, not for vacation but for actually attending a board meeting. And without spilling much, I can only tell you, there are many, 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 many paper companies floating around in tax havens, and obviously the time is coming where all these paper companies, right, would basically be drowned in the tax litigation per se. Interestingly, grandfathering is not available for abusive arrangement. The manner in which Supreme Court has interpreted, we have effectively done away with grandfathering. In fact, couple of days back, we have amended our standard terms, which we sign up with clients, where we are specifically saying that any advice which we give, unless you specifically hire us to analyze GAR, analyze MLI, analyze the PPT test, our advice does not cover that analysis. And many of you would be issuing CA certificates. At some stage, you have to find a way to basically say that I'm issuing a CS certificate, I'm prescribing a particular rate of tax. That rate of tax will be, filed, with the tax office online portal. But sorry, I have not analyzed the GAR provisions. I have not analyzed the PPT provisions. Now that's going to be interesting how each practitioners, put that disclaimer, because that's the fact per se. Uh, while while I've written here double taxation has become imperative for tax treaty benefit, it's put up by my team. My view is I don't think that was the context in which Supreme Court basically said that. So I just hope some more clarifications are provided by the government. And more importantly, GAR versus JAR, right? The McDowell doctrine of colorable devices alive and kicking, which I always thought it is, but it just makes the analysis and the responsibilities of tax advisors far more onerous. I can't just rely on a codified tenure of GAR. I have to also look whether this whole transaction could be regarded as a colorable device, which was held in the McDowell case per se. Uh, so we'll of course put it up for question and answers. But I just want to make 2, 3 comments here. M&A transactions are going to become more complicated. The indemnity clauses which a buyer will ask for will be much more onerous. Tax advice will become costlier because every advice will come with a very, very detailed evaluation of GAR, MLI, PPT test, etc. It can't just now be a 2-pager analysis. All the structures will have to be reviewed because, as I mentioned, effectively the way the Supreme Court has analyzed the grandfathering under Rule 10U, right, there is effectively no grandfathering. I also believe that many financial structures, right, especially the feeder funds which are created in Mauritius or Singapore, some of them may like to look at a gift city and see whether the benefits are available under the domestic law itself, where the first question they would ask is that I don't want to rely on a treaty. Is there any domestic route where I can get more or less the same benefits? In certain cases, not in all cases. Like if you create a Cat 3 AIF which invests in derivatives, right? A gift city structure is a much better structure than coming through uh, a Mauritius or a Singapore or a Dubai, etc. So you will see the popularity of gift, maybe increasing a bit, and clearly what happens to the ongoing open cases for past structures. I think clearly this is, a huge weapon in the hands of the tax office. So clearly this judgment is going to resonate a lot and lot and lot in the coming years. So we are clearly in a very, very different era. The era of treaty shopping is absolutely dead, and I'm quite sure about it. So I think with this, I'll just stop my presentation, and if there is, any questions, very happy to, have that.
So Vishal, we have questions in the chat box, so I may just read out them to you. There's a question from Khushbu. She says that as a tax deductor, how will the deductor determine applicability of PPT residency test?
Uh, Sorry, it's
Hital, your voice is coming a little broken.
yeah. I couldn't hear you, Hetal.
So just to reiterate, there are some questions which are written in a chat box.
Right.
One first question is from Khushbu Maru. She says that as a tax deductor, how will the deductor determine applicability of GAR, PPT, or residency test?
No, absolutely. And see, this is going to be pretty interesting because what happens, Harshan, let me take a couple of practical examples. Let's say I'm making a payment to a company in Dubai, and the Dubai company is providing me certain technical services, right? And under the India Dubai, there is absence of a FTS article. There is no fees for technical services article. And in the absence of a permanent establishment, therefore, there is no taxable presence of the Dubai company in India. So ideally, basis the interpretation of treaty and many judgments favoring this particular scenario, uh, normally the CA would have said, okay, I agree with the analysis, and a zero tax is payable. But now the payer would say, wait a minute, I'm slightly worried because I don't know whether you are a paper company. I do not know whether the tax office would deny the treaty benefit applying GAR. So I don't want to take a risk. So let me deduct a higher tax, and you go and file a return in India, and you go and claim a treaty benefit per se. So that would be one scenario, Harsh, where I believe that you will see payers taking a more conservative view, where you will say, I don't want to use the treaty. I will just use the withholding under the domestic tax law. The second school of thought is that at a withholding stage, right, I can't be put in the shoes of a tax officer. I can't be told to analyze, the whole GAR provisions, and therefore I should be allowed to rely on a certificate, of TRC. And ultimately, right, it is the tax office who has to take the final assessment. That is the second school of thought, Harsh. And while I do believe, that the second school of thought is sound, is more correct under law, where on a prima facie representation submission of a TRC, I should use the treaty rates. I think the real world is going to be much more complicated. If the tax is not to be borne by me as a payer, I would say I don't care. I don't want to take any risk of a withholding, a penalty, or interest. I'm going to deduct taxes under the domestic tax law. You go file a return, claim a refund, and you deal with the tax office. But interestingly, if ultimately the tax is to be borne by me as a payer, because many times the service provider would say, hey, I want this amount. Whatever is the tax, you please do a back working and you gross it up. Then I would be interested, then I would collect more evidence that what if tomorrow the tax office attacks me as a payer. So therefore, this will depend on case to case basis. But you will clearly see payers taking a more conservative view, and you will also see chartered accountants refusing to give a certificate, outrightly saying that this is the rate of tax or this is an exempt tax, etc. So wherever there is a zero tax or a highly concessional tax, for example, let's say dividends to Netherlands shareholder, the treaty says 5%. I don't know if any CA will be ready to sign that, unless he's comfortable that there is enough substance in Netherlands. So it's going to be, as I mentioned, very interesting. Your advices will become costlier. Your advices will become more time consuming. The payers are likely to become more conservative. And you might have more and more 195 applications being filed before a tax office, saying, I don't want to take a call, let me try and convince the tax office. So I think I see that kind of a era coming into it.
Okay. The next question is, this ruling is in respect to FDI. How will this impact FPI category 1?
See, what happens is that uh, an FPI is generally governed under a specific, section of taxability under the domestic tax laws. But if a FPI attempts to take a zero tax, saying that, what, I'm coming via a Singapore treaty, and while a Singapore treaty now taxes capital gains on equity shares, it does not taxes capital gains on derivatives, right? Non-equity shares, non-shares. Uh, I think this is where the FPI will have to prove that it is eligible for the treaty benefit. And not just GAR. I think most of the treaties, barring Mauritius, where the PPT test is not active, but which I believe will become active anytime in this year. Most of the treaties have to be passing through the principal purpose test. So, moment any foreign investor is taking a zero tax view, saying that for so and so reason I'm taking the treaty benefit and I'm not paying any taxes, I think clearly they will have to review as to how confident they are, how much tenable their structure is. So yes, I think this decision also impacts the FPI, because if you really look at the Supreme Court decisions, they are not giving a blessing to the FPI. They are simply saying that I am going to give a grandfathering to a clean investment structure. If the investment structure is not clean, it is abusive, then I will treat it as an abusive arrangement, as an impermissible arrangement, but that can apply even to an FPI. So I believe the risk of an FPI claiming a zero tax on non-share transactions is as high as any other corporate who is trying to claim a zero tax advantage. So probably they'll have to review that, do they meet the test of a GAR, of a PPT test under the treaty per se.
Uh,
I think the next question, relating to that is that, whether this will affect the GIFT City master feeder structure. Answer is not really, because see, from a income tax perspective, while from a FEMA perspective, a GIFT City is a territory outside India. From an income tax perspective, the GIFT City is a territory inside India. And GIFT City structures are regarded as resident structures. So as long as the taxation of the GIFT City structures are under the domestic tax laws, the decision of Supreme Court tax treaties have no relevance. So that's one of the reasons I believe that if a particular gift city structure is giving a concessional tax rate or a tax holiday, that is something which will be now be latched on by the foreign investors, saying that I just don't want to get into this whole headache of whether a treaty benefit is available or not. Let me try to take a benefit under the domestic tax law, right, which is much clearer. So I think gift city master feeders will actually become a bit more popular. But again, if you look at the gift city tax benefits, those are far and few. So in respect of master feeders, I think apart from a Cat 3 fund, I don't see any significant benefit of creating a feeder structure in gift city apart from certain regulatory benefits per se. So unless the government makes tax benefits slightly wider and it covers a Cat 1 and Cat 2 also, right? Gift city will only be beneficial for Cat 3. And in my view, most of the feeder structures which are being made in Gift City, let's say a Cat 2 structure, they are not for tax benefits. They are being made because of certain regulatory relaxations. For example, a FPI set up in Gift City can have 100% NRI participation, whereas an FPI set up outside Gift City cannot have NRI participation beyond 50%. So there are certain regulatory advantages of creating feeder structures in Gift City. But this decision is not going to impact the gift city structure because gift city structures are regarded as resident structures. I think there is again one more question that are some observations obiter dicta. Now, interestingly, even the obiter dicta of a Supreme Court, is regarded as a binding law, in my opinion. So, while of course Mr. Salve, who was representing Tiger Global, in one para he did mention that this is an obiter dicta of the Supreme Court in the past case, but I think effectively whether it's the ratio decidendi or it's the obiter dicta, I think typically these observations are regarded as establishing the law under the jurisprudence principle. So may not really help to decipher what is obiter and what is not per se. They have now all become law of the land. And this is where my fear is that Supreme Court's observation, which is an obiter dicta saying that there has to be a double taxation to take treaty benefit, is that going to be stretched? And to which in my view, it will have to be read in the context in which the Supreme Court has observed that here.
More questions from the I think Vishal has answered all the questions raised in the chat box. Yeah. Shraddha, you answered the question.
I
And
want
there are
to, maybe Hetal, what I can do is, maybe most of us are CVO practitioners and, maybe I want to just comment on how this is going to change the practice a bit, and how the world is changing, for international structuring. Let's say I want to, invest in South Africa, and if you look at one of the best treaties, it's Mauritius South Africa Treaty per se. Now, can I tell a client that, the Indian company should form a company in Mauritius, the Mauritius should form a company in South Africa, and basis that, they can have some really good tax exemptions. And let's presume that the anti-abuse regulations in South Africa are not as onerous as the Indian GAR provisions. But the point is that many of the treaties might have the MLI PPT test. So you have to read that to say that what is the justification you will give to create a company in this Mauritius to enter South Africa. Again, somebody says that I want to do some kind of a, let's say, a commodity trading, and can I form a company in one of the tax havens where, let's say, the tax is just 5% or 1% or 2%. You then have pillar two, which has been enacted by many companies, many countries, where you have to look at the pillar two implications, where if your overall tax is less than 15%, there could be impact under other jurisdictions. Treaty shoppings are being banned. Every country is coming up with anti-abuse rules. So what is happening is that compared to what used to happen 25 years, where in the overall planning we will create beautiful boxes to kind of enter and multiple tiers. I think it's becoming much more difficult, to do that. And most of the time you will realize that, forget this zero tax. Let's have a direct investment in many, many cases per se. So from a practitioner's perspective, I believe that the responsibility on all of us to explain to the client that you will need economic substance, has become much more. I've seen so many of our, companies in India, they create Dubai trading companies. So from India, you will sell the good to the Dubai, and the Dubai company will sell it to Europe and elsewhere. And a lot of these trading profits are housed in Dubai. But if you ask them that who is managing the Dubai company, who is interacting with the customers in Dubai or in Europe or USA, etc., right? Most of the people are sitting in India. Now it doesn't work. A client says, I need tax efficiency. I want to save taxes, but you have to do it in the right way. The bigger you become, you have to understand that the tax risks are much more. And at some stage, we'll have to concede that no, if I'm not able to create the right substance, if I'm not able to shift senior people in some of these, I would say, tax efficient countries, then it doesn't make sense for me to come up with a structure which after a couple of years I have to dismantle. Because the tax risks, the penalties, the interest, the litigation, now is just too much. The bigger you are, that is becoming a bigger headache. And I think this whole Supreme Court decision is just a reminder, that the days of paper companies are over per se. I don't think the clients can take it, for granted. And I believe to a great extent that responsibility is on all of us to basically tell the clients that this doesn't work, it has to stop. And if you do not stop, and if you're unlucky and you're caught and you're mired in litigation, the cost of defending that litigation could be much, much higher. The taxes and penalties will take away all your proposed benefits. So you rather grow your business than do what you call an impermissible tax planning per se. So clearly the tax structuring is becoming, I would say, very, very complicated in the new world. Yeah, sorry, Hetal, these were my comments.
Vishal bhai, we have one more question from Khushbu.
Yeah, yeah.
It's would MAP had been a better approach to deal with this matter?
And in theory, yes, but I think in practice, see, what is a map? Map means that uh, the two tax offices come and sit together, right? But if one disagrees, okay, sorry, I'm not going to give you a zero capital gains tax, then MAP doesn't work. Also, MAP takes a very long time. So in real world, Khushbu, what happens is that you will use MAP for something very different. For example, uh, subjective questions like where is the poem, or questions like, is this the right allocation of profits between two countries? But for a matter where the tax office stand is very clear that we will not allow a zero tax capital gains go scot-free, I think generally a map may not work, because in a map you need to have a fair expectation that the tax office of that other country will agree to my proposition per se. So maybe in a fact like Tiger Global, I don't think a map. And in any case, on a lighter note, a map would mean that the Mauritius tax office has to sit before the Indian tax office. So it is like, getting a cow before a tiger. So it's not you're getting a US tax office, sitting before an Indian tax office, which is a match of equals. So may not have worked in this particular case, I think. Yeah. Sorry, you're on mute,
You're
I
on
think.
mute.
Yeah.
Yeah. Sorry. Do we have any more questions from anyone? Okay, I think there are no more questions. So we'll head on to the VOT. Harsh?
Yeah, sure.
Yeah. Thank you, Vishal bhai. We just spoke to Vishal bhai on this Saturday on the 17th, and we conveyed our intent to have this session on the recent ruling of this Tiger Global, which is a much talked thing in our fraternity. And with an immediate yes, he with his tight schedule, he was readily available for us, and he agreed, and we planned the session in such a short notice on the 22nd. So, Vishal bhai, thanks a lot for your time with such a short notice, and you are always available for any events that we plan at CVOCA and for our members. Your coverage was very comprehensive, covering the facts, treaty interpretation, revenue contention, assessee arguments, court reasoning, which reflects an exceptional command over the subject. Your clarity and balance in the presentation made the session intellectually enriching and practically relevant. And uh, your ability to simplify the complex reasoning, legal reasoning, and connect it with practical implications is truly amazing. So the session was very insightful, and also you brought out the aspects in a very lucid manner. Became very easy for us to really understand this complexities involved. So on behalf of everyone at CVOCA, I extend a hearty vote of thanks to you, and I would request all the participants to carry out a digital applause for our speaker today.
So thanks a lot. Always a joy, whenever there is a CVOCA event. Thank you.
Thank you, Vishal bhai.
Thank you,
a lot.
Vishal. We'll end the meeting here.
Yeah, okay.
Henrik, can you close the meeting?